Good day, everybody. My name is David Lemonson, and I'll be your host for the second portion of today's Fund Manager Workshop. My colleague Doug did mention on the onset about the wildfires ravaging Cape Town outside our office as we speak. I've subsequently had a few messages from my colleagues asking how they can support the efforts there. There is the VWS, or the Volunteer Wildfire Service, who rely a lot on public donations, and of course they're the ones putting their bodies and lives on the line out on the mountain. There is the local SPCA, who are harboring all the injured animals. So spare a thought also for the man who has to catch all the puff adders and Cape Cobras as they make their way out of the tall grass. And then last but not least is an organization who we've worked quite closely with in Nedgroup Investments since the onset of the lockdown, and that is Ladles of Love. Excuse me. And they've been really supporting the efforts on the ground in terms of providing food and meals for the displaced UCT students, as well as the local residents affected by the fire. So we realize it's tough economic times, but if you do have spare room in your wallets to support the efforts, I'm sure every cent is greatly appreciated. I happen to live below the mountain, so apologies to our next speaker, Omri Thomas, who I'm emanating, I think, fire smoke from every pore in my body, from my hair and from my clothes into the nasal cavity of Omri. So apologies for that, Omri, but there is an analogy in there somewhere. If we were to rewind a year ago, the Opportunity Fund was in quite a challenging position. As of today, I think it's one of the top performing funds in the category. So the analogy with the fire and I guess the recovery that we're seeing as the lockdown swept its way across the world over the course of the last 12 to 18 months or so. So without further ado, given the performance of your fund, Omri, I think we're very much looking forward to hearing what you have to say over the course of the next 15 minutes. Thank you.
So thank you very much for the opportunity to give you feedback on the Opportunity Fund and what a difference a year makes. So if we look at the performance, it's pleasing to see that on all performance periods, the Opportunity Fund has recovered. So we've been very blessed over the last year. And a lot of the instruments that really impacted the fund last year, that we've held our belief in, have come through strongly and have delivered the performance for the fund. So we can see over the last year, the fund has delivered about 37%. And I think even when compared, despite its low equity content, even if you compare that to the average equity fund, that was a reasonable return. Obviously, that is backward looking. So today I'd like to give you a bit of a perspective on why we think there's still opportunities left in our market, and we think it's still a good time to be invested in the market. So just looking at the winners and losers last year, and I'm not going to go through all the details, it's in the slide pack for your perusal. But I think what's pleasing to see, if you look at the winners over the last 12 months, two of the instruments that we think differentiate the Opportunity Fund from other funds, and that's sort of the hybrid instrument. We make very much use of hybrid instruments within the fund, either directly through investments in the likes of a convertible bond or a preference share, or sometimes we structure asymmetric return products like the Euro stocks notes that we usually use within the fund. And if you remember correctly, the Euro stocks notes last year in March, with 2 weeks to go, we saw the collapse of the Euro stocks index, and a lot of that accrued value that was sitting in those Euro stocks notes, it fell back to that capital guarantee level. So that was quite painful, and to ensure that it didn't happen again this year, because it was almost a similar position. Two of our biggest positions were handsomely in the money, in fact showing an 80% return. Now there was still another 20% to go, but because of the lesson that we've learned last year, we actually unwound both those investment notes and banked that return, just from a risk management and a portfolio construction point of view. If we look at the asset classes, and Philip and Nick have both referred to us, but we continue to see quite a bit of value in South Africa. Most of our asset classes looking reasonable. Bonds hovering between fair value and cheap in our view. SA property, we still think offer decent returns. We're still excited about the hybrid opportunities, and I'll show you a couple that we've got within the fund. And then within equity, we still think you can get decent value. On the other side, if you look at developed markets, most of those asset classes are expensive. We've seen global bond yields also ticking up. So there's a bit more uncertainty in global markets, and that must be a bit of a tail risk in that the S&P is at record levels, and that's despite inflation pressure starting to build. We don't know if inflation will really come through. There's a lot of debate on that, but I think the risks have increased. So looking at our asset allocation, I've just contrasted it to where we were in December. You would have seen the SA equity portion has increased. It is both due to us seeing more value in SA equities than developed markets, and also due to performance. The equity market has had a strong start to the year. Bonds we've decreased slightly, even though we're starting to see value in bonds. We remain concerned about the fiscal position in South Africa and a potential fiscal cliff. So our bond duration is still fairly short, and sort of a conservative allocation to bonds. SA property, we bought into property the start of fourth quarter of last year. That's done very well for the fund, and we have started to take profits in select property companies, but still see value in the remaining shares that we hold there. Convertibles and prefs, again, that hybrid part of the portfolio, we're still quite excited there. That's grown mostly due to performance. So the Royal BAFOKENG convertible bond has done extremely well and one of the top contributors to the fund's performance. But we've also added the SAPPI convertible bond that did well for the fund. We've recently bought into the BRAIT US dollar convertible bond. And then we fortunately got a long-held position in the PSG prefs. And just this morning, PSG announced that they're making a buyout offer for all the PSG prefs at 81 Rand a share plus accrued dividends. And the pref was trading about 65, 66 Rand per pref. So that's a nice premium to the price that we held it at. It's a position that we've held for a long time, and we've been positive on it. And as Abax, I think we own 30% of all the issued PSG prefs. So that should be a nice contributor to returns. Offshore equities, you'll see we've got quite a low exposure due to our concerns on valuations. Offshore bonds, mostly South African names offering us a yield spread above US Treasuries when converted back to Rand is a very decent return in Rand terms. Cash at about 3% and very little offshore property. So just looking at our top positions, no surprise, NASPERS still remains our top position. It's always been a rotation between NASPERS and British American Tobacco. And I'll speak a bit more on NASPERS. You'll also see I've included the Royal BAFOKENG convertible bond as within our top 10 equities. And the reason for that is the share has done so well, and that share price is well above the strike price of that bond. So its performance will be directly linked and impacted by the performance of Royal BAFOKENG Platinum. So in our view, that is now a full equity. It's past the conversion date we can convert, and in fact we have given notice on a big part of our position to convert into shares, and also to start reducing our position. Not that we're negative on the company, but it's done so well that from a portfolio construction point of view, it's quite a big portion of the fund now. So we will be looking to reduce that position. You'll also see that we've got First Rand and Standard Bank in our top 10. So banks, not fireworks, but decent value with decent dividend yields at attractive ratings. So that is still in our top 10. And then our Eurostoxx notes, and I'll speak more a bit about the Eurostoxx note basket. So this is just a breakdown of our fair value model on NASPERS. And as you can see, it's still over 50% discount to what we see as the fair value. Now, In recent years, the last 3-4 years, management have started taking actions to try and unlock some of this value. They sold 2% of Tencent, their Tencent shares 3 years ago. Over the last 3 years, they've used that to do more acquisitions and also to buy back some of their own shares, as well as Prosus buying back some of its own shares. And they've just announced another sale of 2% of their Tencent shares. So we would have liked them to use those proceeds to just buy back their shares, but they have indicated that they will use it to do further investments. We're not that excited about it, but if you give them credit, you can say they're trying to bolster the scale of the non-Tencent investments, and by doing that, hopefully enable them to unlock value through listing or selling or actually spinning off those assets into a separate company. We would have liked a bit more progress, but it'll take time. But at the moment, you're still getting it at such a discount that one can still wait for that unlock. Just our hybrid exposure, that's 20% of the fund. Investment notes making up almost 10%. Our convertible bonds making up 9%, and then preference shares, that's mostly the PSG pref, at 2%. So just looking at the investment notes, you would recall that a big part of our basket is on the Eurostoxx index, and you'll see the nice recovery that we've seen in the Eurostoxx index. If you contrast that to what's happened to the S&P, it's a very muted recovery. So one could expect the Eurostoxx index actually to continue performing. But we've got a total exposure of 9%, on average 1. In fact, as I said, 2 of our bigger positions we've sold in the last day or 2. So that has now reduced further. It's actually only a 7% or 6.5% position at this point in time. The average yield to maturity of our basket of notes is 22%. Now, in a yield-starved world, we think that's a very attractive return. The weighted duration is under a year to expiry, and us being able to get that return. So 8.5% of the 9% is actually expiring within the next year. So unless we replace it with new structured notes, that will reduce as a percentage of the portfolio, but we've earned a very good return on that basket. As I said, it's spread over 10 different notes. It's spread over 4 different assets, so it's not only on the Eurostoxx index. We've got other underlying assets within there as well. And 8 out of the 10 positions are already above that level where we can get that return. Only 2 below the strike price, and those are 2% below and 4% below. And their remaining duration is just under 4 years. So this is just to show how well that Royal Bafokeng convertible is done. The red line is the strike price. The green line is the share price of Royal Bafokeng, and the teal or blue line or light green, whatever your screen resolution is the Royal Bafokeng convertible. And you can see how that has tracked that share price. So it was a position of about, if I remember correctly, about 4% 18 months ago. It's grown to over 7%, even as we've sold, and we will continue to take profit at these levels. The SAPPI convertible bond, the red line is again the strike price. The blue line is where we bought the SAPPI convertible, where the share price was then. And one can see how quickly it actually went through at strike, and it's delivered quite good returns for our multi-asset funds. The BRAIT convertible, quite a busy slide, but it's just to show that currently trading at about 78 pence, and we see the fair value is about 88 pence, so another 11% or 11% undervalued. It's got a coupon of 6.5% in pounds, and its yield to maturity is over 14% in pounds. And we do think this is quite or would be one of the options if BRAIT looks to start unlocking value. They could look at buying their own convertible and getting that return themselves. So in summary, I think while global markets look expensive, we still manage to find decent value in the South African market. We have started taking profit on some of our best performing positions. We're still positive on NASPERS and British American Tobacco, our two biggest equity positions. We remain a bit cautious on the fiscal outlook for South Africa, so we've kept our bond exposure relatively low and our duration quite low. And despite our low offshore equity position, given the rand strength, we've tried to maintain maximum FX exposure through the use of currency overlays to ensure that if the rand blows out, that the fund is hedged against that risk. So at this point, we're quite comfortable that the portfolio offers a good mix of growth and yielding assets, and that we've got attractive asymmetric return instruments in there, which will help protect the fund in a downturn as well. Thank you very much.
Cool. Thank you so much, Omri. And maybe a little bit unfair, but I'm going to put you on the spot here. When I woke up this morning and unlocked my phone and started reading the news, the updates out across the pond in the US was the Biden administration looking to clamp down quite aggressively on the tobacco sector. So I think that's around limiting the nicotine content, as well as I think an all-out ban on the menthol. How have you read this news? Because I know BAT is a big holding in your fund. I think it was the third biggest as per your slide there. Yeah. Has it affected your valuations at all?
So it would have been great if the news only came out tomorrow post my presentation. No, Dave, I think that is not a new thing. The Democratic Party has had it in for the tobacco industry for a long time. If they want to change legislation, that'll take a 5 to 7 year. It'll take 5 to 7 years for them to do that. So we think for that to happen successfully will take a very long time. So this is not new news. It's happened before. What we've seen in markets where menthol has been banned, as to their saying, is we've just seen a shift in consumption. So BAT will be relatively more affected because they've got the biggest market share in menthol, but the total market size won't reduce. It will also push users into sort of what we call heat not burn and non-harmful tobacco products, which is actually the biggest growing part of all the tobacco companies' profits. So we think this sell-off actually creates opportunity to add to one's position. I mean, BAT is trading at a pound yield of over 8%, at a PE of about 8 times. And they generate a significant amount of cash, which they'll use to reduce debt and also in time hopefully buy back some shares. So it is short-term pain, but what we've seen in the past, this creates opportunities to actually increase one's holding.
Okay, thank you. Yeah, I haven't looked at the share price, but I imagine it's come under significant pressure so far this morning. Also have to confess, I don't cover your fund from an investment specialist point of view, but one thing that was eye-opening for me was your significant exposure to the SA REIT sector. I think it was about 7% or so. So I'm a little bit conscious of time. We did start a bit late, but just in a minute or so, this is quite contrarian, so what is the investment thesis behind this?
So these companies have, I think one has to be selective. There are going to be casualties within the REIT sector. What we've seen globally is a significant rebound in REITs. I think our South African market has lagged. There's been some rebound, but you are buying a lot of these REITs now at discounts to NAV of 50% plus, and on dividend yields exceeding in double digits. And we have seen a recovery in rentals, and so year on year, you're actually seeing good growth in terms of the REITs. There was a lot of concern about the balance sheets. I think with the results coming through, it will help some of the balance sheets, but restructuring will still have to happen in quite a few of the REITs companies. So you have to be selective where you're at, and we think the companies we've got exposure to look like decent value.
Okay, excellent. Thanks very much for your time this morning, Omri. As always, appreciate it.
Thanks very much.